welcome to Sectors Up Close. I'm Elena Casas. Our focus today is on emerging market investing, and my guest is Jim Scheinberg, the Chief Investment Officer at Pier Search Consulting. Well, with US stocks sitting at historically high valuations, there is a case for emerging markets. The argument for investing in EM economies is that they are generally growing faster than developed ones and have rising middle classes, but this hasn't always translated into market gains. So far this year, the main index that tracks this varied bunch of large and mid-cap emerging market stocks is up 6%, so about half the gains seen in the US S&P 500. As well, EM indices such as this one can be lopsided. As you can see, China takes up the lion's share here. And while the country has been an important staple of EM investing for years, that's been at the expense of other markets. Outside of these, there are a huge range of emerging markets to choose from, and that makes EM investing not only challenging, it also increases the risk, especially considering unpredictable governance in some economies and geopolitical tensions with countries such as China and Russia. So, how should investors approach the sector? Let's ask Pier Search Consulting's Jim Scheinberg. Jim, hello, thanks for joining us. Like many of your peers, I know you're bullish on some emerging markets. Why?
Well, again, Pier, we have the access to the largest OCIO managers in the world that are running and allocating institutional capital. So our opinion is really formed on what we see in their overweights. And it's a general theme as we do our research and talking from OCIO to OCIO that we hear most of them are and have been overweight the emerging market sector. There's a few areas, I think you hit on the key ones at the top, which is valuations are considerably more favorable in those markets than they are in the United States specifically, as well as potentially compared to developed market Europe when you compare to their growth prospects. In addition to that, the expectations for growth and the stability of that growth going forward looks very attractive. And that growth is tied to a resurgent developed market in the US economy. So it all folds very nicely together.
But we're having this conversation in a very low interest rate environment. But many investors may remember the taper tantrum of a few years ago and the realization that lots of emerging markets gains were overly reliant on central bank money. So how do we know that won't happen again?
Well, it could very well happen again. As a matter of fact, JP Morgan put a piece out in January that actually showed what happens to global equities when you do have rising interest rates. And in fact, the number one equity arena when interest rates are rising is emerging markets. They actually have a tailwind as interest rates are going up. In some cases, we like to look at emerging markets as a big bucket, but the reality is that you can break it up either into Latin and Europe and Asia. We like to look at it as manufacturing versus resources. Resources and resource-rich countries do very well typically when you have rising rates. Seems like we're seeing that in some basic material and metal stocks right now. That can be very favorable to that end. And as as economic activity increases, generally that global consumption is picking up, again, favoring the manufacturing side of the EM story. So rising rates, as long as they don't kill the global growth, should be good.
But is this best left to professional investors who understand the geopolitics? How should your average investor approach this sector?
Well, the average retail investor can either go out and look for really competent emerging markets managers, and I wouldn't necessarily look for the ones that did the best over the last year. You want to find the ones that have managed themselves very consistently over the last decade, because as we all know, emerging markets have been a very bumpy ride since 2008. You want to find the managers that have a steady hand. For more institutionally focused managers like endowments and foundations, those OCIOs that we consult to, the consulting community, they're actually not only seeking independent portfolio managers in the public emerging markets, but we're seeing a lot of capital flow to emerging markets on venture, on private equity, and especially actually on private debt now. We're seeing that increase as well. And so it really depends on what seat you sit in.
But is this a particularly risky sector? I mean, is it a consequence of US equities offering low returns? Are people just taking bigger risks?
Well, there's no question that emerging markets has been a more volatile sector. I can't argue against that. There's been, as I said, a series of wins and losses just over the last 12 or 13 years that's a little bit dizzying. But if you look at the way emerging markets have traded in terms of their valuations in comparison to other major global markets, when emerging markets are substantially cheap, and right now we're well over one standard deviation below where they normally would be in terms of their valuation gap between developed market international and US, that's normally precisely the time that you want to be an emerging market investor. You may end up with some bumpy roads between now and when you get a regression back to that valuation mean, but it has happened pretty consistently and probably will again.
Thank you. That was Jim Scheinberg, CIO at North Pier Search Consulting. Well, before I go, here are some of the top stories in the emerging markets space. Turkey's central bank has responded to a slide in the value of the lira by raising its year-end inflation forecast to 12.2%. Central Bank Governor Sahap Kavjolu also said the bank's main policy rate, which is now 19%, would remain above inflation. Kavjolu was appointed Turkey's fourth central bank chief in less than 2 years after Turkish President Recep Tayyip Erdogan sacked his hawkish predecessor for raising interest rates. The South African rand has emerged as an unlikely winner among emerging market currencies since the COVID-19 pandemic swept the globe, despite high levels of debt and unemployment. The currency is up 2.4% this year and about 30% over the past 12 months. South Africa offers some of the highest yields in major emerging markets, with 10-year bonds yielding just over 9%. Commodity prices have also boosted demand for the currency. Analysts told Reuters that when compared to currencies such as the Russian ruble or Turkish lira, the rand has been trading, quote, like a safe haven. And finally, Reuters can exclusively report that major Chinese investors are in talks to take a stake in Saudi Aramco as the state oil company prepares to sell another slice to foreign investors. Saudi Crown Prince Mohammed bin Salman said on Tuesday the country was in discussions to sell a 1% stake worth $19 billion to a leading global energy company. Sources have since told Reuters the sovereign wealth fund China Investment Corporation was among those that could invest, as well as Chinese national oil companies. Saudi Arabia is China's biggest supplier of crude oil. And that's your roundup of the emerging markets sector. I'm Elena Casas, and this is Reuters.